your income ranges and the corresponding tax records for each bracket is hugely valuable. So knowing which bracket you fall into can help you estimate your tax liability and make informed decisions about income and deductions. Understand that the system is a graduated tax system, meaning that only the income that falls within a certain bracket is taxed at that rate. Hi, and welcome to Beyond the Paycheck. I'm Paula Christine. So today we're going to discuss tips and tricks about how to save on your taxes for 2024. Now, I know you're thinking, hey, I haven't even done my 2023 taxes yet, and you already want to talk about 2024. But the sooner you get started, the more money you're going to end up putting back into your pocket. Now, I know, tax is boring, but when you start to understand how the tax system works, you can start putting more money into your pocket, and that can be really exciting. So I want you to grab a pen and paper and stick with me for maybe just about the next 10 minutes or so. The first tax tip that we're going to talk about is embracing the power of planning ahead. So I'm going to share with you two different concepts that you can understand what I'm trying to say when I talk about planning ahead. And these are things that you're going to want to do as soon as you can in the beginning of the year. So let's look at Sarah. She's a freelance graphic designer. And so at the beginning of this year, she decides that she wants to open a solo 401k. Solo 401ks are a great savings tool for the self-employed. It not only allows you to put in money out of your paycheck, but also allows you to put in contributions from the business. So Sarah sets up an automatic contribution from her paycheck. So she maximizes those contributions throughout the year. And at the end of the year, when she does her taxes, she'll be able then to determine what she can put in from the business. Now, additionally, Sarah starts tracking her business expenses. Now, I know when I first started out being self-employed, I was horrible at this. And I lost a lot of things that I could deduct on my taxes because I wasn't really keeping good records. So you really want to keep records of all the things that you spend on your business. So we're talking about software, office supplies, mileage, anything that you're spending to do business. A lot of times people forget to keep track of, entertaining clients. That's something else that you can write off. Now, if you keep good records throughout the year, it makes it so much easier at tax time. Again, I still, even being in business for 24 years, suck at that. But what I do now is I make sure that I put everything on my credit card. So when I go to do the taxes at the end of the year, then I can just download everything from my credit card and categorize everything. There are much easier ways to do it than I do. So by planning ahead, Sarah can not only save for her retirement, but she also reduces her taxable income. Now let's look at Michael. Now he's a W-2 employee. He's working as a mechanic for an auto repair shop. Now Michael's employer doesn't offer him a retirement plan. So Michael decides to open up his own traditional IRA account. Now he contributes to that IRA monthly, and these contributions will reduce his tax liability plus boost his retirement savings. So for both Sarah and Michael, both of these situations are a win-win. So our second tip is to educate yourself on tax credits. So tax credits are like hidden gems. A tax credit is a dollar for dollar reduction on the amount of taxes owed to the government. So unlike deductions, which reduce your taxable income, tax credits reduce the amount of taxes that you owe, making them a very valuable way to lower your overall tax bill. So let's look at that as an example. So let's say that you owed $1,000 in taxes, but you're eligible for a $200 tax credit. That would mean that you would only need to pay $800 in taxes instead of that $1,000. Now there's a ton of different tax credits out there. I'm not going to go over them, but I'm going to talk about two. So let's talk about Lily. So Lily's always wanted to be a nurse, so she decided to go back to school. So because she went back to school, she qualified for the lifetime learning credit. So this credit can be used to offset some of Lily's costs of her tuition and textbook, making her education a little bit more affordable. One thing that I think is overlooked a lot is the Savers Tax Credit. Now, it is a valuable incentive designed to encourage low to moderate income families or individuals to save for retirement. So the Savers Tax Credit works like this. It provides a tax credit to eligible individuals, there is some income limits, who contribute to their retirement savings plans like their 401ks or IRAs, And it gives them the ability to offset the taxes owed by using this credit. So the credit amount varies based on the individual's adjusted gross income, their filing status, and the contribution limit, with higher credits available to those with lower income who save for retirement. So I know everything I just said was probably confusing. So let's take a look at an example. Emily, she's a single mother working full-time. So Emily contributes to her employer's retirement plan. So let's just assume Emily contributes $2,000 to that retirement plan. Now it comes to tax savings time. And because of her low income, she's able to take that $2,000 that she put into her retirement plan to offset some of the taxes that she potentially owed at tax time. So as an example, let's say she put in the $2,000 and then she owed $3,000 at tax time. So Emily would get a tax savers credit for that $2,000 that she put in. So if she owed $3,000, she would get $2,000 tax credit. So then she would only own $1,000 in taxes. I hope that makes sense. It's a great way to encourage people with lower income to start saving for retirement. Now, I know one of the things that when I sit down to help my 24-year-old son do his taxes is that we're going to look to see if we can make that contribution into a retirement account to help reduce down any taxes that he might owe for this year. So it looks like it might potentially be a win-win for him. Now, you're saying, well, wait, Paula, he hasn't contributed throughout the year. But up until April 15th, you're still able to contribute to a retirement savings account, like an IRA. So it is possible that when you sit down to do your taxes, that you may want to discuss with your person doing your taxes about, contributing today and taking that savers tax credit maybe for 2023. Or for 2024, you can just start by saving into an account right now. So tip number 3, educate yourself on deductions. So deductions are expenses that you can subtract from your taxable income, reducing the amount of income subject to taxation. So common deductions could be like mortgage interest, charitable contributions, medical expenses that exceed a certain threshold. So for instance, if someone earns $50,000 a year annually and contributes $5,000 to charity, they could deduct that $5,000 from their taxable income, potentially lowering their tax bill. Now, in order to take advantage of what we just talked about, the mortgage interest, charitable deductions, medical expenses, you're going to need to itemize, or what they call do a Schedule A when doing your tax return. Other than that, you likely would just qualify for a standard deduction. Now, for investors, there's a thing called a capital loss deduction. So it allows you to offset capital gains by deducting losses incurred from sales of investments such as stocks, bonds, or real estate. So let's look at that for example. If someone sells stocks for, say, $3,000 loss during the year, and they also sell stocks for a $5,000 gain, you can deduct the $3,000 loss from your $5,000 gain, resulting in a net taxable gain of only $2,000. So this would reduce your overall tax liability on the gain that you would have to realize that year. So again, you sell something for a loss, you take it from the gain, and it would lower the amount of the taxable gain for that year. So I'm going to stop here for a moment because I really want to make sure that you understand the difference between a tax credit and a tax deduction. Now, for example, let's compare a $10,000 tax deduction to a $10,000 tax credit. Now, in these examples, I am very much exaggerating the numbers to make the point. So a tax deduction reduces your taxable income. Let's say your AGI, your adjusted gross income, is $100,000 and you have a tax deduction of $10,000. It will reduce your taxable income to $90,000. Now let's assume you are in the 25% tax bracket. So the taxes owed on $90,000 would be $22,500. Now, a tax credit works this way. Your adjusted gross income is $100,000. You have no deductions, so your taxable income is $100,000. You're in the 25% tax bracket. Your tax liability is $25,000. You receive a $10,000 tax credit. So $25,000 minus $10,000 tax credit, you would only owe $15,000 in taxes. It's important to understand the difference between the two. A tax credit is so much better than a tax deduction. But having both of them is also very awesome. So when you think about it, if you qualify for a credit, you want to take advantage of those credits. You want to go back and, there's a long list of credits. Go back and educate yourself on what those tax credits are so that you can see that if you're planning ahead for the year, there might be something that you can take advantage of. But you need to know it now, because once tax season is over, or once the year is over, you can't take advantage of it. So please educate yourself on tax credits. Let's move on to tip number 4. So I want you to understand how your tax bracket and how the tax system works. Becoming familiar with your income ranges and the corresponding tax brackets for each bracket is hugely valuable. So knowing which bracket you fall into can help you estimate your tax liability and make informed decisions about income and deductions. Understand that the system is a graduated tax system, meaning that only the income that falls within a certain bracket is taxed at that rate. So if you use it correctly, you can manage your finances to minimize your overall tax burden. So let's suppose you're a single individual with a taxable income of $50,000, which would put you in the 22% tax bracket. Now, not all of your income is going to be taxed at 22%. Some will be taxed at 10%, some will be taxed at 12%, and then anything that falls between that $40,526 to $50,000 is going to be taxed at 22%. Now, I'm going to round some numbers off here because it just makes it easier for me to explain and talk. So let's think about this for a second. If I know that everything between $40,000 and $50,000 is going to be taxed at 22%, then I'm thinking, what if I contributed to let's say a IRA or my 401k, and I reduced down my adjusted gross income to under $40,000, how would that work? I know I'm struggling thinking this through, but I want to make sure that I get it out correctly. But if you think about, so if we have $50,000 income and we contribute, say, $10,000 to our 401k, and that puts us at $40,000 for our adjusted gross income. So because our income is under $40,000, we will fall in the 12% tax bracket. So that means that the income that you earn between $40,000 and $50,000 will not be taxed at 22%, and it'll save you $2,200 in tax dollars. So think about that. By contributing $10,000 to your retirement account, reducing your income from $40,000 to $50,000, you've now put yourself in the 12% tax bracket, saving yourself $2,200 in taxes. Now, I also know that you're going to say to me, but Paula, if I make $50,000 a year, it's not likely that I can put $10,000 into a 401k and still pay my expenses. I get that. I just want you to understand the concept. So when you think about things and, thinking about saving for your retirement, that might give you an incentive to go ahead and do that. Because, if I'm saving $2,200 in taxes, that's a lot of money. Now, again, I want to throw out that disclaimer here that I rounded up numbers. So don't be yelling at me that I'm completely inaccurate. I just wanted you to understand that concept. So I probably just blew up your mind. That was just so much information at once. So the last and final tip that I want to give you is seek professional guidance. It's so important to talk with a qualified tax professional. They can help you navigate everything that I just talked about and make sure that you are taking advantage of every opportunity to save on your taxes. Just before I recorded this episode, I was on the phone with my CPA. I work with a professional because I own a business and I want to make sure that I get every allowable deduction and credit that I qualify for. Now, I just touched on a small amount today of some of the things that you can take advantage of with deductions and credits, and just reach out to somebody who's much more educated than I am to talk about what's best for you. Like I said, I talked to my CPA just as I'm getting ready to do my taxes and some of the things that I was sending over to him, before we recorded. And we also talked about that after tax season that we need to sit down and kind of think about what we're going to be doing for 2024 and 2025, as things change in my life. I hope this podcast did not bore you to death. And, if you were listening while you're driving or walking, I hope you haven't fallen asleep. Just kidding. I know it was a bit boring, but super informative. I want to thank you for joining me today. I want to mention that if you would like to educate yourself on all money matters, check out my course, Making Money Matter. You can find it at my website at paulachristine.com. And you can also find several other tips there or resources, not tips as much, but resources to help with paying down debt or budgeting. Just check it out on my website. Now, if you found these tips helpful, I'm looking for some feedback, so always shoot me a quick email at paula@paulachristine.com. I want to thank you again for listening today.